You're listening to the Option Alpha podcast from OptionAlpha.com, where we show you how to make smarter trades, learn how the stock market really works, and generate consistent monthly income. Now, your host and head trader at OptionAlpha.com, Kirk Duplessis.
Hey everyone, this is Kirk here again from OptionAlpha.com, working every single week to make this the most popular investing podcast offered in iTunes because it's based on one thing and one thing only, and that's helping you make smarter trades. So again, thanks so much for tuning in today. We've got an awesome interview today with Josh, who is the founder and the head trader over at OptionSizzle.com. And actually, Josh and I go back a little ways because he interviewed me for one of the products that he sells on his website, where he went out and interviewed a bunch of traders out there. And I was fortunate enough to be one of the guys that he interviewed for one of the things that he sells. And so now I've decided to kind of flip things around a little bit and interview Josh and kind of get his story on how he came up in trading from the early days as a CME floor runner, then till going to become a stockbroker and then managing money, and then finally just trading on his own and building, his own businesses, which is really, really cool to hear. Now, what's really great about Josh's story is that he trades very similar to the way I do, but he's got a little bit of different twist, which is always good to hear from other traders. And he's an expert at unusual options volatility and volume. So if you're looking for that type of information, this interview is going to be really helpful. Again, it's just a little bit longer than usual, but we went through a lot of different things and kind of broke it down into what he looks for and how he looks for it with regard to unusual trading activity and volume in options. So without further ado, let's get right into the call. All right, so we got Josh on the phone. Josh, thanks for joining us today.
Well, thank you for having me.
Well, thanks for being here. And like I told everyone before in the intro, you got a really cool story about how you got started and where you're kind of at with your trading. And the reason I want to bring you on is because I was fortunate enough to be one of the guys that you interviewed for one of your courses that you have on OptionSizzle.com. And so I figured, hey, I might as well repay the favor. And now I get a chance to interview you and ask you a bunch of questions. So if you don't mind, let's just get started here by just telling everyone just a little bit of background about who you are and kind of where you came from as far as trading. I know one of the key things about you that I know is that you don't have a fancy business degree. You didn't get started that way, but you actually got started kind of being a runner on the CME. So can you talk a little bit more about that?
Well, if you remember our interview last time, I like to talk, so it's good now that I'm on the other side. I started on the floor, like you said, at the Chicago Mercantile Exchange. And before then, I was delivering pizza with a dream of wanting to be a professional wrestler. Shortly going into the pizza industry, that started to wear off. Right. But what I realized when I was kind of doing that, I didn't really have any direction of like what I wanted to do with my life. I knew from delivering pizza and then short term being a manager that I didn't want to be in the restaurant business, and I wanted to make a lot of money, but I really didn't know how to do that. I went to a local college. It was a junior college for about a few days, and then I decided that wasn't for me as well, because my dream at that point was to become a stockbroker. And my boss at the time, and still a good friend, Rod, had introduced that idea to me. I remember the day pretty vividly. We're in the pizza place, and I think it was like the afternoon time, and he's like, well, and he was my manager at the time, and now he's the owner of the pizza places. But at that time, he said, if I wasn't doing this, I think it'd be cool to be a stockbroker. And that was my aha moment. So a couple doors down, there was an Edwards Jones office, and Ed would order pizza slices sometimes. And one day I went over there and started talking to him, and I asked him a couple questions about how to become a stockbroker, because I saw movies like Wall Street and Boiler Room, and I'm like, whoa, all this money that can be made, I can do that. So I went in there and I started talking with him. He asked me if I had a book of business and if I had a Series 7, which I didn't know any of that. But right. He wanted to let me know that that's kind of what I needed to get to. He told me he used to work on the floor of the Mercantile Exchange, and that was probably my best opportunity. So I did what only one can do, is I cold called every place in that building to look for an opportunity. And I finally got an opportunity at a firm called Spike Trading. And I worked for them part day, and then the other day I worked for a clearing firm called FC Stone.
Okay, cool. And so what were you doing just real quick on the CME for people who don't know what runners do kind of working in that business?
Yeah, I mean, it was a good opportunity, and like he said, it was a foot in the door to kind of direct me to where I wanted to be. Uh, Being a runner is the person that goes into the pit. So for those that are not familiar with how the CME works, it's an open outcry system. So in older movies, they have like these guys yelling in the pit. They're not yelling, they're trading, but it sounds like yelling. I would have to go into that mix and collect cards because that's how they verified their trades on cards. And I would have to go in the pit, and then I would have to take them to the clearing firm on the floor. Then there was another floor in the building that I would have to clear that. So there's a clearing process of where off the floor that they go and to enter the trades, and then the tickets go upstairs for processing. So I would have to go into these pits sometimes, and like some of the busier pits then were like the Euro Dollar, the S&P pit, the two main focus ones, and then the Nasdaq future ones um, were pretty active as well. But I would go in there, collect the traders' tickets, and I have to get out of there as quickly as possible because if these trades weren't verified in a certain amount of time, there was a problem. It came on to me, and there was an issue with it.
Right, gotcha. So once you did your time being a runner on the CME, and then you had moved into, I believe, becoming a stockbroker. And so, can you talk maybe, just real quick, and then we'll kind of get into where you are now. But kind of that transition. What you learned from not only being a runner on the CME, but I know you were, trying to follow trades of people that were, trades that were coming in from other, parties like Goldman and J.P. Morgan. So what did you learn from making that kind of transition to being a stockbroker and trying to follow those trades?
Well, the direction I wanted to be was a stockbroker because that's what I saw in the movie. And when I was on the floor, I just looked at it as an opportunity. And I learned about the market on the floor. And when I went to become a stockbroker, I realized I didn't want to be a stockbroker because what I really wanted to do was to understand the market, and brokers don't do that. So, kind of the mix of what happened between that time frame and starting Option Sizzle was I created a lot of opportunities for myself. So I was on different sides of the financial industry. I raised private equity. I was on a trade desk. I was on an options desk. I was on the portfolio side for clients. I When I started as a broker, I was a junior broker making 600 calls a day and wearing the phone out,
Wow.
and doing it that way, doing it the boiler room style. And then when I was doing that, that's when I realized, okay, this is not what I wanted to. And one of the ways I would open accounts would be the uniqueness of talking about what you're saying about that kind of order flow. And that was just something I learned and kind of saw on the floor of the Chicago Mercantile Exchange, is that there's floor traders, or local traders, and then there's brokers for Goldman Sachs. And then you would see kind of when there's quiet times or just kind of sitting back behind the pit, because I wasn't allowed to stand on the pit. You can only stand if you have a seat there in that pit. So you have to stand off to the side, and you can't stand in the direction because there's brokers around the floor. So in the beginning, I got almost fired one time because I was standing in the view of a broker that was trying to provide signals to the other broker to place trades, and these are big trades. So me in the way lost them some money, and I almost got fired for that. But you
For
would
just
see a
standing
lot of
there.
times
That's
the
crazy.
locals take trades based off of certain people, and those people they witnessed as like the big money. So I went in and I would always ask questions because I was interested. I didn't understand. I didn't know what futures were or what a tick was at that time and all these kind of terms. So I would ask questions, and when I was able to get an answer for them, that's kind of when I learned about why locals would pick off certain traders and kind of see and witness the order flow. And if Goldman Sachs all of a sudden came in and bought a big lot of futures, that some other people would kind of get behind them as well, and you could start to see the market move from that.
Right. So they were kind of leading the way a little bit, which is kind of cool. And I think just your whole story is so fascinating too, because I like that you have so many different things that you were involved in. And oftentimes I feel like some people don't appreciate how good having that kind of well-rounded knowledge of the market. I mean, being on so many different sides, you kind of get to see it from every different angle instead of, just being an investment banker or just being a prop trader, whatever the case is. So I think that's something that's really cool, and hopefully has been able to, allow you to, get to the next level where you are now. So, can you talk just a little bit now about, kind of where you are with your trading now? Because, you're not a broker anymore. You don't want to do that. So where are you at with your trading? What's kind of your trading style or how you like to trade options?
It's really evolved from when I first started. And my first trade was when I was a broker, and I put $2,000 on an earnings play for Research in Motion at the time for for BlackBerry phones. Um, and I quickly lost that money. And this was, granted, I was a licensed Series 7 financial investor
Right.
or financial professional, and I studied my butt off. And that's kind of what opened the door for options at that time, was when I focused on the Series 7 part and focused really on options because I was told that was the hardest part. And so I had the Series 7 and thought I knew how the market worked. Wasn't the case. So that's kind of what started the learning process, and that's where kind of the disconnection of what people think professionals are compared to what they actually can know how to navigate the market or know what to do with different products and strategies. And over the years, it's really evolved. I mean, I first started, like most people, trading direction, and what that means is buy an option and looking for the direction to be right. And from there, I had gravitated into selling of options, and I knew that. And when I managed money after I left my last firm, Chicago Investment Group, and in the process of starting Option Sizzle, I was managing money in 2008, which is the worst time. But that's kind of really a big crash course for me on options, on the fact of, you have to be able to learn how to navigate not only in bull markets, but in volatile markets. And to be able to do that, you have to understand how Kirk talks about a lot is implied volatility, and to be able to understand why options are expensive, and understand how that influences the pricing of options. So,
Right. So do you think that most people, when they get started, look, it's very easy for people to get started buying options, but even people that I've seen that are quote unquote experienced traders, or traders that have been in the business for a long time, you'll often find that they also are, buying options or buying spreads because they think it's better. But what do you think is the real disconnect for people when it comes to buying versus selling, and making directional bets versus not? What's kind of the missing piece?
I guess you kind of have to think about it with what would you do with your own money. And you're right. And it kind of, I wouldn't say frustrates me, but it's kind of like when I hear people that are taught as professionals talk about that, I'm like, I kind of shake my head. And if they can make it work, they can make it work. I mean, that's all on them. But, from my experience, if you it's tough to bite. It's tough to chew on that. So what you asked earlier about my approach is, similar to what you do, in a lot of the aspects of the edge comes from the overestimate of implied volatility. So I look a lot of times to sell implied volatility, looking for that contraction. Now, kind of the difference that I look at to do now and have done is that I like to, what's kind of a buzzword is unusual option activity. And a lot of people from when I started talking about this and quoted on it have come up and kind of talk about it and tweet about it and post a lot of noise. It's not the holy grail, but for me, when I look at and can decipher that kind of information, it gives me a little bit of, I guess, in my mind, a higher probability if I see calls being bought in a certain aspect, and I can start to create a trade based off of that. So
Right.
a lot of times people will, like what you're talking about, like just buy calls in some unusual, in a name that they think is seeing some unusual call activity, or may have someone had tweeted about it, and they follow that same trade. And these are out of the money calls. Now, I'm looking to probably sell that out of the money call and buy a closer, if depending on implied volatility, or I might sell a put or create a structured trade. So I use it for idea generation and creating strategies and using option strategies based off of that.
Right.
So those are my directional bets that I like to take sometimes or use. It's exciting for me. Selling option premium is not the funnest thing at all times. You might be right a lot, but there is a little bit of excitement that you get if you get the right movement and you see the option. You buy the spread for $1 and it goes to $1.75 pretty quickly, and you're kind of pumping your fist. That's the excitement that I kind of get sometimes from it, and the reason why I still like to do it. And I think I think that's what helps create separation for individuals, is that if you focus on what is going to create you the highest probability of success, that's going to help you. But to create that separation, and it's the same thing in business. One of the person I like to call them Mark Cuban trades, is because you see this very odd buying in these names, and what I'm looking for is a lot of times these names are being taken over, or they're having some kind of DKS was one that was just recently going to be taken over, and about a month ago there's these out of the money calls being bought. So my Mark Cuban trades are kind of those aspects, is hopefully getting lucky following one of these, and getting a big payday, which can really help make or break your year, or just separate you overall from creating long-term success. Because if you can, add on another 1,000 a month, or not a month, another 1,000 over the year, that hopefully will compound over the next several years to, be much more, just by having that kind of those little bit of Hail Marys or long shots or Cuban trades.
Well, and I think what's cool is that, and I often talk, and I think it's so cool doing this podcast and interviewing so many different traders, is that you hear that, we're all basically doing the same thing, just with our own little different style and tweak. And I like that your, kind of style is unusual options activity, because that's something that I don't check that often. I mean, if I see it, I'll, maybe post a video or comment about it on Facebook or Twitter, but that's something I'm not going out and maybe looking for. So in that kind of, just sticking with that topic a little bit, maybe we could go through kind of step by step, a situation that you might find, and how to kind of analyze, what's happening behind the scenes. Because I know that, sometimes it can be hard for people to know, how is that trade, how do I know which direction that trade's being made? So let's take, for example, just some stock, but let's say that the out of the money calls have really crazy, volume. Like there's 20,000 contracts that were traded. So what are the things that you might look for to know, what kind of trade that is, and what's the kind of process for going through that?
So the first one you always want to look at is the underlying, and that's important because there's a lot of block trades that go off, like an SPY and bigger names. And if it's a 20,000 lot, that's not really that unusual to me. It's more of the under the radar names, or ones that are not in focus. So a lot of people go after and what you were asking about earlier, like people kind of doing the same thing, or kind of people buying of options. A lot of times it's more focused on if they're doing it with their own money, or if they're doing it with other people's money, I mean. Right. So professionals get paid on the fact of having your money and investing it. They don't get paid sitting on the sidelines. And that's why there's usually the bias in the marketplace of a move higher, because they have to invest those funds. They only make money off of that. Getting back to the unusual option activity, if we look at something like SPY and there's a block of 20,000, that's not really unusual to me. I want to find something that isn't that focused, like Apple, or something not like Apple, because Apple's a very heavy name and it's very competitive, so it's hard to get an edge. And I use edge a lot when I describe this, but I want to be able to decipher as close as 100% that already these calls are being bought. So
right, but let's take, okay, so if it's not Apple, and I get that, that's true, that a big block of 20,000 in SPX or RUT may not be high because just the contracts that get traded. But let's say, I don't know, it's just a a lower name but still a popular name, maybe like Home Depot or Lowe's, and you see something where most of the time the strikes are a couple hundred to a couple thousand, but then for some reason there's a 20,000 volume in one strike that's far out of the money.
Yeah, so we start looking at that. So what you asked was the first step. Is that's how I weed it out. If it's something like that, I'm not going to try to decipher if there's buying of this ETF, because there's a lot that goes behind it. I want to find ones that I can easily make a judgment call on. So we get to that when we start looking at the accumulation. I start looking at the order flow. So the service that I use, I pay a couple $100 a month for. It provides the option data, all the option data from all the exchanges, and it helps aggregate all the information for me. So a lot of this process is just experience and kind of having a system to kind of weed stuff out. There's no exact science to it, and that's why a lot of people struggle with it at first, because they want to buy every call that they see or every unusual thing. But there's millions of option trades that go off every day, and easily I can define 100 of them that could be unusual. So
Right.
the definition for me on unusual is I take the average volume of the options traded for that specific contract or that specific underlying, the last 22 days, the average of that, and whatever, if it's exceeding that, that would be unusual. And then from there, then we start the process.
Okay.
So
Right.
Home
So
Depot, we start looking at, and those out of the money calls are they're traded. We could see that there's volume. So the open interest on them is 1,000. All of a sudden now there's 20,100 and 500 contracts. So we start looking at that, or I start looking at that, and I start to kind of look at the blocks or see how it trades. Now, if it's like a block of 200, a block of 500, yada yada, that starts to be interesting, because that means that this wasn't a block trade, and block trades are usually traded off the market. They're not entered on your platform. It's like not me and you are just entering a block of 20,000 of contracts. You have to find the other side of that. So you call down to the floor. Firms have to find the other side of that trade. So that's not really, and that's kind of what we don't want to look at as well, because that could be a hedge. We want to see kind of that accumulation of volume or these blocks that have been traded. You'll take a look at the implied volatility for that option strike. Supply and demand dictates implied volatility. If they're being bought, so if they're traded on the offer, the likelihood of it is that they're being bought. Because if you buy an option and there's a 5-point spread, there's the bid and the offer. Well, if they're being on the offer and the volume's exceeded, that's a good indication that these are bought. Now we can look at the implied volatility and see if they moved higher. And if the implied volatility has moved higher, that's a good indication that these were likely bought.
right.
Now,
So can we just take a step back and just you're just to kind of summarize, you're looking for, and I think it was a key point too that you kind of maybe just went through because you know it so well, is that you're not looking for, just the actual just number on the screen. I think maybe sometimes that's what people get wrong about unusual activity, is that they look for just a number on the screen. They say, hey, here's a big number, it's got to mean this. What you're doing is kind of looking just a little bit deeper and saying, okay, how's that number being, how is that 20,000 contracts that just got traded or are going to be traded, how does that come about? Is it, a steady order flow? Is it just one trade at one time? That's what you're more looking for, right? Kind of the underlying, fundamentals of it.
yeah, and there's a lot of belief that there's no information behind that, or behind kind of unusual option activity, but and that's true to a point, and it's true for those types of trades. The ones I'm trying to look for are the ones that kind of what we're talking about, are the ones that are not those big obvious trades that look, oh, there's something going on here. It's the ones you kind of have to investigate a little bit more. We're looking for not actively traded names like Apple that are very competitive on bid and offers and highly liquid in volume. We're looking for things like Home Depot, where we can start to kind of get a little bit of an estimation of some indication if we can say, okay, yes, this looks like these calls are being bought or these puts are being bought, or maybe they're being sold. And if they're being sold, we can kind of get an assumption from there and start doing that. But
Right.
obviously, people get more excited about wanting to buy a call for $1 and selling it for $3. So that's why I kind of always lean to the fact of the call buying or put buying.
Yeah, sure. Yeah, just that defined risk, unlimited, potential feature. So, all right, so you've kind of narrowed down, what strike it is and how the order flow is. So what's kind of your trading setup to profit from that? So like, let's say, and let's do both cases real quick. So let's say that, you find out that that's actually somebody or a group of, firms buying a bunch of call options. What's kind of your setup? Will you still buy that same call? Will you do something around that strike? How do you set that up?
Well, I'll take a look at the overall implied volatility at that time. So not just that strike's implied volatility, but the implied volatility for that whole month or for all the contracts, and kind of get an estimate from where that's at. So if it's into it all backs into my overall system of what I look to do. I always look at implied volatility. You have a podcast about implied volatility and how important it is, and that is more important than understanding the Greeks.
Right.
And what I'll take a look at is the on Thinkorswim, which I'm pretty sure you use as well. They have an implied volatility percentile.
Yep.
And I'll take a look at that. And depending on where that percentile is at, that's going to help me weed out what strategies to use. So it might be an out of the money call. And if the percentile is very inexpensive or very cheap, I actually might look to do something with that option, because the indication for me at that point and the thought is, alrighty, the implied volatility is pretty cheap here, or inexpensive compared to what it has been. I'm not going to, cheap
Right.
is not a good word.
Cheap's relative,
Comparison to what it has been, it's on the lower end of its range, or whatever you want to reference it to. And there are, and seems to be, a directional bet here with some decent size amount of money being behind this. So to look at that, I would say, okay, I might go with that same option at that point.
Right.
Now, if it's the other way around, where that volatility is at the upper end of its range, that's where I actually will look to sell that option, and I might come a little bit closer. I'll come closer, not might. I will come closer to where prices are to create a higher probability of a trade and sell that higher at that point, because we talked about if that implied volatility in that option has increased, it might not have increased for all the options that are available, but for that specific one it has.
Right.
And that would be a better one to sell and to come closer to buying, to creating a spread, and to also have a better probability. Or overall, I might just look to sell a put or a put spread, and price is going to dictate that, and implied volatility is going to dictate the strategy.
Right. Well, what's cool is that you do a very similar process, but I think it's such a smart thing to do, because once you find out what it is and you kind of understand kind of what you're dealing with, then it does come down to volatility being the factor that dictates which direction you go with your strategy. And I think you're right. I mean, it has a lot to do with where implied volatility is, and then ultimately what strategy you select. So when it comes to you've decided to make a trade in it, how do you narrow down the amount of money that you're gonna allocate to that strategy? Because you had mentioned earlier that what you're doing with these unusual options activity trades and kind of these Mark Cuban trades is that you might hit a couple of these every year. So given that, is there a certain allocation that you'll put to them, or is there situations where maybe you'll allocate a little bit more money in a certain setup versus others?
Yeah, the Mark Cuban ones are the kind of the those are really under the radar names, and they're really odd call buying. Those are the Mark Cuban trades are the ones I think are the ones that are something could be happening, or I want to get involved in, that I want to find. Those, in my mind, I reference those as the Mark Cuban trades, because I think those could be the game changer for the account. Typically on something like Home Depot and kind of the other things like that, those are just basic trades. Those fit into my overall approach of having some direction, having directional bets up in my overall approach to keep me engaged into the marketplace, keep me engaged as well with what's going on, and create some excitement. And typically it's the same percentage throughout. It's going to be 1 to 5%. Typically 5% is depending on how good opportunities are existent. 1% is going to be when things are not really that hopping in the marketplace, not
Right.
that popular. So
Gotcha.
this slidingness, and it's typically about 2%. But the key to kind of what was selling of options as well is, if you buy options, you have to have a lot of occurrences. You have to have a lot of them available as well, because sometimes what I've seen over the years of people trying to do unusual option activity is that they, let's say, pick 3, and then they have 1 goes against them, and then 2 kind of break even. But if you have 3 trades, that's not enough.
Right.
You have to have kind of a diversification, and you have to kind of keep that overall risk down. So 5% is kind of like if you have a really smaller account, but typically you want to keep it to 1 to 2%, because you at 1 to 2%, you're hopefully keeping your profit curve going higher, and you're not going to have one trade that's going to make or break you.
Right. So, and I think, look, I think this is, one of the key points of this podcast and interview with you is that I often hear that people will, kind of put a lot of money into unusual options activity because they assume that there's unusual activity. It means that the company is going to get bought out or, go bankrupt or whatever the case is. And so they'll throw a lot of money into it. And what's really interesting is that you're still sticking to kind of your game plan and your whole philosophy is, I'm going to take advantage of these opportunities, but I'm not going to, put all of my money into one or two trades that I see.
Yeah, it's also that you're spreading your risk, and you never know. I don't know what's going on. I can get in. There's a lot going on. There's times where I miss things that are so obvious that when I look back, I'm like, man, like it was so obvious that what was going on here, and I neglected to. I had to wait a day, or just I wanted to see one more day of activity, and then you miss it, and that's going to happen. And then there's always going to be opportunities that are existent, and you're gonna like look back and you're like, oh man, I saw that one. But there's so many as well that it could be information overload and you could be chasing the wrong things. And that's why, this is a tough, it's not the holy grail. It's not it's sexy. It's the sexy girl, but it takes a lot to make this work. And,
right.
Like you might want to, marry that girl that's looking pretty good, but, in a relationship, there's a lot that goes into it. So same thing with unusual option activity. There's a lot of kind of experience that goes with it, and you kind of have to know and kind of play with it to have a process to be able to kind of understand this. At the same time, like I said, these individuals can be wrong as well. Just because they are acting on something that they might believe can be beneficial and may have a reaction to the direction that they're looking for, it doesn't mean the market is going to see it the same way. I was involved, and there's a couple times, but I remember this one. I was right on. Unusual buying of calls out of the money, not too far out of the money, but out of the money, followed the guy right behind him. And a couple days later, an announcement was made that the company was going to go private. I bought the 1250 calls. The deal was at $12.70. This guy, I think we paid, I don't know, 60 cents for the calls, I think. That was a losing trade.
So you're just out, yeah.
Whoever bought those calls didn't understand derivatives as well, and he's thinking maybe this deal is gonna go to $20 or something. He's acting on this information, and that's me assuming that this person knew. Now, I mean, sometimes things could look that way, but insider trading is a gray area, and it's not my pay grade to say who, and I don't know what these trades are. That's why we have government and the SEC to overlook that. And not everything that just because something happens is insider trading. There's a lot of times where these firms do a lot of research because they're looking for an edge to be able to benefit from it. They do a lot. They have access to the same information that we have, but they do have a lot more money to hire people to kind of go through this information to get a better estimate. So yeah, I call that leverage. I like to let them do it. But I'm setting up myself for better probabilities by structuring trades because, again, I don't know if this is going to be right. There's an assumption that this is a directional bet, but just because the guy at the roulette table has been hitting all reds doesn't mean he's going to hit the next red one just because I put in bet behind him.
Right. And I think, it's interesting because like when I was in investment banking doing M&A, I mean, even though, we're on the different side of the wall, obviously on the, private side, but there's still firms out there that do their research and know, if a company is going right down the line and starting to acquire, this technology and that technology and that technology, I mean, you can pretty much make a pretty good guess, what company may come next, right? If they're, acquiring all these different kind of, businesses that, are going to help them build a new product. So that doesn't mean, again, like you said, that's, going to be great information or not, but they're just making strategic bets based on what information they have. But I think the most interesting thing you said is that unusual activity is like women. We can't understand them, and that's so true, right? So
it's a little tough at times.
It's tough. I know it's tough for, I don't understand my wife half of the time, but I love it. Okay, well, cool. So let's talk about one more thing as we kind of wrap up here. So me and you, before we started the call, we're just, kind of talking a little bit about, how people build accounts and, kind of prepping, for this call about the questions I'd ask and stuff like that. But can you talk a little bit about, how people get started in building their trading account if they don't have a lot of money, and that can be different for different people. So it doesn't have to be that, 10,000 is a lot of money or 1,000 is a lot of money, but people generally need to be building their account. And you had talked about this idea of, you diversify in the market, so you've got to diversify outside of the market. So tell me a little bit more about how you think about, trading as it relates to just kind of your overall financial picture and wealth.
Well, I mean, I've been in the financial industry. I'm 30 years old, so I've been doing this. I'm almost going to be 31 in about 6 months, 4 months, and I've been doing this for a decade. I've have experience, and I've been able to experience different things, which is a blessing. Um, Managing money and all that aspects of the market, it's tough, and sometimes it's a little tough at times when losses happen, and you have to kind of, if you're banking just on the fact that you want to make money from the marketplace, you're not going to make money every day, and months sometimes it's going to be a little tough. And when I first started option sales, my big idea and my big dream was, man, I'm going to be able to trade from anywhere, and I'll have a website, and all these people are just we're going to have this cool club, and people are just going to want to hang out with me. But wasn't really the case. I mean, business is something that's a lot different, and it takes investing in a business as well to be able to get your message and your information out there. And and this is kind of where that, not that dream has disappeared, but the reality is that my belief is that you can't create. You can't have an income source just solely from the market. I love the market. I love options. I talk about options to my girlfriend all the time, and she doesn't have any interest in options. And I go to parties, and everyone wants to know, which we might get into, about this other business that I have. But when I talk about options and options and what I've done most of my life, like, yeah, okay. And then I say the other thing, they're like, oh, really? That sounds really cool. And in the back of my mind, I'm kind of like, man, no one has any interest for options.
No, yeah, you can't bring it up at a Christmas party, that's for sure.
Yeah, which I did, and didn't go over to it. It's like, yeah, okay, well, yeah. So being 30, I'm young, and it's all experience, and I'm on the same journey as you and other people as well. Is I'm on the course. I want to create wealth, and from what I've learned from other people that have been able to create success and wealth, is that they don't have it all on one investment or one thing. And my belief is that, especially with the marketplace, with it's random, and it's up and down, and it's tough, and it's tough to make it work, and it's a long learning curve. I mean, for myself, I'm still learning. I'm still learning from the things that I did when I first started trading options, where I was the cocky little kid that can pick direction and was 100, was on top of moves and could be on top of the market. And then I got slapped a little bit, and I got beat up by the market, and now I come back a little bit more humble.
Right.
So for me, I have Option Sizzle, which is an investment, which helps me not have to solely depend on one income source, because that's tough. Sometimes you have to kind of put money into your account. Sometimes you got to take it out. And my thought process and what I want to accomplish for myself and my family in the future is to have wealth. And to be able to have wealth, you have to acquire things, you have to build things that are going to continue to work for you. So you were talking earlier, like you had mentioned, one of the things I have as well is another business that's based off of Amazon. It's selling physical products. The article that you talked about was on Option Sizzle that I wrote about, and it's something I get and have been asked often, is like, how do I get started with $1,000? And I've had the thought process, and to get started with $1,000, there's two different camps. You either have $1,000 and you have a good kind of stable income where you're making good income, because as an investor like me and you, we're not professionally backed. And that's the difference between professional investors, is that they are financially backed, and the risks that they take are much different compared to you and I, where we don't have access to capital. The only way we get access to capital is that we got to go work a part-time job, like you had mentioned before, like be it a bartender, or find something where we can have income coming in, because it's going to take some time for this to work. And this is not the like this is going to be the $1 million business, because this takes a long time to kind of compound and let it grow and have work for you with the learning curve. So if you're in a good position and you're starting with $1,000, and that's great, you should be learning how to manage your money your own. Now, if you are delivering pizzas like I was, and I'm interested in the marketplace, and I'm trying to, create wealth and create freedom and options for myself, then you probably want to figure out something else to do with that $1,000 than to try to make it work in the marketplace, because it's not really that much. The guy that is in better position, that's a learning tool for him.
Right.
He can burn that $1,000, and not say burn it, but
It's
you're
tuition. It's market tuition.
Learn.
Right.
You're going to learn. You learn with real risk, and he's not trying to make this work for himself. He's not trying to say, I'm going to turn 1,000 into 25,000 by the end of the year. As to the guy that's delivering pizza, he's kind of on that more risk of like, I want to turn this 1,000 into 25,000.
Right.
And that's kind of how I compare the two of them. Now, it's kind of where you put yourself into, but if you are wanting to kind of create something that's long term for yourself, you got to put yourself. You have to have you got to get a skill. You got to get something that's valuable that you can fall back on at any time to be able to say, alrighty, something happened in the market, because it's going to happen. People lose $5,000 accounts. I lost 2,000 very quickly. I've lost more than that as well. And if you only have 5,000, then that's gone. You have to be able to acquire more money, and 5,000 in the marketplace isn't that much.
Right.
You have to take on more risk. Your occurrences are going to go down, and you have more risk to it. Some people can make it. Some people have. Those are called outliers. Those are called a small percentage of people. The majority of people fall into the same camp of where I lost my first $2,000 and I lost it all. And I'm like, okay, this wasn't as fun as I thought.
Right. Well, and I think, and I don't want to obviously discourage people, but it's important that you mention too, and I always will say this as many times as I can, but this business is about long-term consistency. And I often get people who will ask me, they say, Kirk, how do I be more consistent? That was one of the biggest questions I got at the end of 2013 or 2014 is, how do I be more consistent? And I say, well, consistency is a thing that happens over time. It doesn't happen overnight. And so whatever you do, whether you have a side business, like I think, where you're doing is cool. You got your Amazon business. I know other traders I've talked to, still work day jobs. Other traders have, they got daycares at their house that I've talked to other people, and they trade, with kids and stuff like that. Me and my wife, we have, in rental property that we have, and she still has her job. So it's all about, just being smart with all of your money and your investments, and not just diversifying in options trading, but diversifying outside of the market as well.
Yeah, that's how. Again, that's what I've read and what I've learned from other successful people that I look up to. That's how they've been able to create wealth. It's not from one aspect. It's not from one thing. It's different investments, different things going on.
Yep.
And funny that you said about the consistency, because it's something I think everyone wants. Is they think if I'm more consistent, I'll make money. And I'll put it in this perspective. First, consistency is following the same plan and doing it, win or lose, or fail or success. That's consistency. The outcome doesn't mean that you're not consistent. So, we were talking about option sizzle, and because we've known each other for some time, and you had asked me how long it's been, and I told you it's been since October 2008, and you had asked me about last year and so forth. Now, I've done a lot of work with articles and creating articles. We were talking about, well, I didn't really see the outcome or the process that I was hoping for. That doesn't mean I wasn't consistent on the fact of doing those articles every week, meaning that my outcome can still be a couple years down the road.
Sure. Oh yeah. I mean, look, my two buzzwords that I've had for the last year and a half that I don't know if I read in a book or somebody told it to me, but is being persistent and consistent. So it's not, and I think you're right. It's not just being, having this level of consistency, but it's the persistence to be doing the right activities, win, lose, or draw for, a long period of time. And I think when it comes to options trading, people get really, really discouraged because they make 10 trades and 5 go bad, and they're thinking to themselves, hey, I'm making these high probability trades, but the problem is you haven't made enough trades. You're doing the right things, so stay persistent doing those things, but you also have to be consistent doing that over a long period of time.
Because it's different than your P&L. It's instant. The fact is that you don't get rewarded for. It doesn't mean you get rewarded for it right now. It could be you get rewarded down the line, right. And it takes time. It happens in business a lot of times where there could be something that you do and it doesn't get the reward, that the satisfaction or that outcome that you're looking for at that moment. And the outcome for a lot of people when they think consistency is like, like you said, I put these trades on. I want to make this money. I'm not doing it for fun, which is correct. But the fact of if you're consistent and you can do it continuously, you will get rewarded. It's the fact of you have to stay that consistent, and your little added on bonus, which is pretty good, is persistent as well. You got to just buckle down and just understand the numbers do work, because it's statistical edge that's on that fact.
They work. Yep, they work. They just got to work over a long period of time. So, well, cool, man. Well, hey, I appreciate you being on the show so much, and I know that we got into so much, so I got so many notes that we're going to put. This will all be archived and posted on the website at optionalpha.com, and you can see the show, and we'll have links back to Option Sizzle so you can find out more about Josh and what he's doing. So how's the best way for people to reach you besides going to your website? Is it best on Twitter or Facebook or email? How do people get in touch with you if they have more questions?
I try to be very accessible. So Twitter is Twitter. I'm accessible on Facebook, or email. All emails go to the same inbox, and it's either going to be myself that responds or my assistant. So I see all the things that come in, and I'm very easy to get in touch with.
Okay, good. And we'll have links for those on the show notes again, so people can check it out. So Josh, man, thanks so much for being on the show today. I really appreciate it, and we'll talk to you soon.
I appreciate the opportunity. I know you don't let many people on, so thank you.
All right.
Thanks for listening to the Option Alpha podcast. If you liked what you heard, please drop by iTunes and leave a rating or comment. Plus, you can get everything: free email updates for future shows, transcripts, video tutorials, case studies, and more. Just visit our website at optionalpha.com.
All right, so I truly hope you guys enjoyed today's show and got at least one thing out of it that you can apply right now to make you a smarter, more profitable trader and investor. And as always, you can find additional show comments and any mentioned links or videos that we talked about today by going to optionalpha.com/show19. Again, that's optionalpha.com/show19. And until next time, happy trading.